What if the silver market isn't pulling back today because something went wrong, but because something finally broke underneath it? Right now, silver is trading around $63.14 per ounce, down roughly 1.48% on the session. And to most people that looks ordinary, a red candle, a pause, a chance to breathe. But when you place that number in context, it stops looking normal and starts looking dangerous. Silver is sitting just below its 52-week high of $64.67 after climbing from a 52-week low near $28.15. That kind of move doesn't happen in a balanced system. It happens when pressure builds faster than it can be released. Today's intraday range, roughly $62.19 to $64.18, tells the same story: wide swings, sudden hesitation, price testing both sides as if the market itself is unsure how much weight it can still carry. In previous cycles, this is where control returned. Selling would accelerate, momentum would crack, confidence would drain, but that's not what's happening now. The drop doesn't cascade, it slows, it stabilizes. And that hesitation near yearly highs is the signal most people miss. Weak markets don't hesitate, they break. Strong ones absorb pressure quietly, even when the numbers flash red. This isn't a breakdown, it's a stress test unfolding in real time. The market isn't asking whether silver should be cheaper. It's asking whether pushing it lower will actually bring metal out of hiding. And the longer price hovers near extremes instead of collapsing back into comfort, the clearer the message becomes. What you're watching isn't indecision, it's constraint. And constraint is the one thing this financial system was never designed to handle calmly. To understand why today feels different, you have to rewind to the moments when this system proved it could still enforce order. In 1980, when silver surged too fast and too far, margins were raised and leverage collapsed. The Hunt brothers' position broke, price unraveled, and the message was clear: no matter how powerful the rally looked, control would return. That lesson was reinforced again in 2011. Silver raced higher, margins were hiked repeatedly, and within days, price fell nearly 30%. Speculators were wiped out, leverage evaporated, and a decade-long silence followed. Those events weren't random, they were warnings, and the market learned to respect them. That memory shaped every reaction that followed. So when silver pushed into the low 60s again, the response was automatic. The same tools were deployed, margin requirements were raised, paper shorts flooded the market, price was driven down, heading into the weekend, painted red with intent. The goal wasn't subtle, it was to force selling, break confidence, and prove that nothing had changed. For a moment, it looked like it worked. Price was shoved directly into the 60 to 62 zone, where thousands of stop-loss orders were waiting. Those stops fired exactly as expected. Retail positions liquidated automatically. Shorts piled in, convinced the pattern was repeating. Fear spread quickly, just like it always had. On the surface, it looked like panic. But beneath that surface, something different was happening. The selling wasn't clearing risk, it was creating it. Every forced exit became inventory for buyers who weren't reacting to headlines or leverage. They were absorbing metal quietly, contract by contract. When that artificial pressure lifted, even briefly, the market didn't stabilize. It snapped back. Overnight, the entire drop was erased in a single session. Not a bounce, a gap. That kind of recovery doesn't belong to a weak market. It belongs to one where the old mechanism misfires. The system relied on fear to shake metal loose. This time, fear produced supply only briefly, and it was immediately taken. That's the moment the timeline bends, because when a move designed to restore control fails, it stops being about sentiment and starts pointing towards something deeper that no longer responds the way it used to. That's where the hidden mechanism begins to matter. This is where the story leaves the chart and moves into the machinery behind it. Because what actually failed wasn't sentiment or confidence. It was the mechanism that had quietly kept this market functioning for decades. And that mechanism has a simple name. Most people misunderstand the float. On paper, silver looks abundant. London alone reports roughly 800 million ounces sitting in vaults. To the casual observer, that sounds like safety, like depth, like a cushion. But most of that metal isn't really part of the market at all. 85 to 90% of it is frozen, locked away in ETFs held by sovereign buyers, parked by family offices that vaulted it years ago and never intended to trade it. It exists, but it doesn't move. And metal that doesn't move might as well not exist. What actually sets price is the float, the sliver of silver that can be sold right now without forcing someone's hand. The dealer metal, the unallocated pool, the bars that can be leased, shipped, refined, or delivered to industry. And over the last several years, that pool has been drained quietly. Not by speculation, by consumption. Silver was turned into solar panels, electronics, batteries, and defense systems. Once used, it didn't come back. It vanished from circulation to keep everything running smoothly. The system leaned on leasing. The same ounce was counted more than once. Notes lent into the market with the expectation it would be replaced later. As long as new metal arrived, the illusion held. But when demand kept rising and replacement supply lagged, those promises stacked up like IOUs written against a warehouse that was slowly emptying. Then behavior changed. Holders who once accepted paper claims started asking a dangerous question. Where is my metal? When unallocated silver becomes allocated, it leaves the float permanently. That forces banks into the market not as traders, but as firefighters. They don't buy because they like the price. They buy because they're exposed. This is the invisible escalation most people never see. It doesn't announce itself with headlines. It shows up as hesitation, as failed sell-offs, as pressure that no longer releases the way it used to. And once the float is tight enough, price stops being negotiated. It becomes a searchlight, sweeping the market for one answer only: who is still willing to sell? Once the float tightened, the market didn't need another catalyst, it needed time. And time is where psychology does its damage. The sharp drop that came before the rebound wasn't just about price discovery. It was a cleansing. Stops were triggered, leverage was flush, and anyone who relied on automatic exits was removed from the field. On the way down, fear felt rational. Selling felt safe. Cash felt like protection. That's how shakeouts work. They reward the decision in the moment and punish it later. When the recovery came, it didn't come gently. It erased the entire move lower in a single session. That kind of V-shaped reversal isn't random. It's what happens when artificial pressure is lifted and natural demand snaps back all at once. Weak markets don't do that. They crawl, they hesitate, they need encouragement. This one didn't. It moved as if it had been restrained, not broken. That's where the psychological escalation begins. Anyone who sold into the drop woke up stranded. Their cash didn't buy safety, it bought regret. Buying back meant paying more. Waiting meant watching price move further away. Most people choose to wait, and waiting turns missed opportunity into pressure. Every dollar higher feels personal. Not like a loss on paper, but like being excluded from something that's already happening. As that pressure builds, behavior changes. Regret turns into urgency. Urgency turns into forced participation. This is how markets move from voluntary buying to compelled buying. Not because everyone suddenly believes the story, but because the pain of not being involved becomes greater than the fear of being wrong. At the same time, the mechanical side keeps tightening. Banks with physical exposure don't get to hesitate. As price rises, their liabilities rise with it. As volatility expands, their margin for error shrinks. That creates a loop where buying feeds more buying, not driven by optimism, but by obligation. Psychology and structure begin reinforcing each other. Markets don't move toward balance. They move toward maximum discomfort. A crash would have relieved pressure. A slow grind would have allowed adjustment. But a relentless advance after a failed breakdown punishes everyone at once. Shorts, sellers, sidelined capital, and professionals who hesitated. That's why this phase matters. What looks like momentum is actually consequence. And once consequence takes over, the market stops asking who's ready and starts forcing alignment instead. Up to this point, everything could still be dismissed as psychology. Fear, regret, crowd behavior playing out on a chart. That excuse ended the moment London opened, because for decades, London played one role and one role only. It was the seller of last resort. When prices ran too hot, London supplied metal. When New York panicked and bought aggressively, London leaned on inventory and cooled things down. The London Bullion Market Association wasn't just another market. It was the pressure valve, the control room, the place where rallies went to die. That's why what happened next mattered so much. When the UK market opened, London didn't sell, it bought, not quietly, not patiently. Aggressive bids hit the market immediately. Real size, real urgency. This wasn't price-sensitive buying, and it wasn't speculation. It was the kind of behavior you only see when something has already gone wrong behind the scenes. Like watching a firefighter arrive at a blaze and start grabbing fuel instead of water. That's not confusion, that's alarm. This wasn't retail traders or momentum funds. This was bullion banks, LBMA participants, institutions that had spent decades suppressing volatility suddenly flipping sides. Banks don't change behavior because they change their minds. They change behavior because their risk changes. Banks don't have opinions. They have liabilities. The trigger wasn't price, it was availability. Not inventory, availability. Inventory is what exists on paper. Availability is what can actually be sold when pressure is applied. When London went to do what it had always done, lean on supply, it found something missing. The metal that usually appeared on demand wasn't there. Not delayed, not tight, gone from the float. That's when strategy disappears. When a pressure valve is empty. You stop managing markets and start managing survival. Buying becomes defensive. Balance sheet driven, immediate. And once that kind of buying starts, price stops being the message, price becomes the result. This is why London matters. For years, skeptics could argue sentiment. They could argue speculation. They could argue charts. They can't argue London. When the most powerful suppression hub in the precious metals market switches from supplying to scrambling, it confirms what price action alone can't show. The bear trap set the stage. Psychology cleared the field. But London pulling the trigger turned suspicion into confirmation. And once confirmation arrives, the system isn't steering anymore. It's reacting. This is where the story stops being an argument and turns into a constraint. Because everything up to now leads to one word most people misunderstand until it's too late: the float. For years, the market comforted it itself with inventory numbers, vault totals, reported ounces, headlines that sounded reassuring. Hundreds of millions of ounces sitting in London created the illusion of safety. But inventory is static. Float is dynamic. Inventory is what exists. Float is what can actually move. And when the market finally tried to access that metal the way it always had, it discovered how little of it was truly available. Most of that silver was already spoken for, locked away, allocated, held by entities that weren't trading and weren't interested in price. ETFs, sovereign buyers, long-term holders who removed metal from circulation years ago. That metal still exists, but it doesn't respond. It doesn't come out when pressure is applied. It doesn't behave like supply. It behaves like bedrock. What kept the system alive was the unallocated pool, the dealer metal, the silver that could be leased, promised, and counted more than once. As long as users returned what they borrowed, the math worked. But silver isn't theoretical. It gets consumed. Once it's built into solar panels, electronics, batteries, or defense systems, it's gone. It doesn't come back to the vault. As consumption rose and replacement lagged, those paper promises piled up quietly. No alarms, no headlines, just a growing mismatch between what was owed and what could actually be delivered. The system survived because no one asked too many questions at the same time. Then they did. When holders began converting unallocated claims into allocated metal, silver exited the float permanently. That forced banks into the open market, not as traders, but as problem solvers. And problem solvers don't wait for dips. They buy whatever is available, because delay increases exposure. This is the mechanism now running the market, not sentiment, not narratives, obligation. When float tightens beyond a certain point, price stops negotiating. It starts searching for someone, anyone, still willing to part with physical metal. That's why price behaves the way it does now. Sharp moves, violent pauses, failed sell-offs. These aren't signs of disorder. They're signs of scarcity asserting itself inside a system built on flexibility. And once scarcity takes control, there's no lever left to pull, only reactions left to make. When supply breaks, price doesn't wander, it looks for the next pressure point. Right now, that pressure point sits directly overhead at $65. Not because it's a round number, but because it's where the market's hidden wiring starts to glow. Silver has been trading in the low 60s, hovering just beneath that level, and the closer it gets, the more unstable the structure above it becomes. This is where options quietly take control. There's a heavy concentration of call options sitting at the 65 strike in the near-term contracts. Those options weren't bought by accident, and they weren't sold by amateurs. Market makers sold them, banks, dealers. As long as silver stays below that line, they collect premiums and walk away clean. But the moment price pushes through it, their position flips from passive to dangerous. To protect themselves, they're forced to hedge. And hedging here doesn't mean paperwork, it means buying futures as price rises. The higher silver climbs towards 65, the more buying they're required to do. That buying lifts price further, which forces more buying. It's not speculation, it's mechanics. A feedback loop where defense turns into fuel. This is why the market grows violent just below that level. Expect sharp swings, sudden dumps, stops hunted around 64.80, 64.90, Every trick used to hold the line, because once 65 breaks, resistance doesn't thicken. It thins, the ceiling doesn't crack, it disappears. Timing matters here. The US market is about to open. Historically, that's where rallies go to die. Asia buys, London buys, New York sells, the 10 smash. It's been reliable for years, but reliability only lasts until it doesn't. And Americans waking up to a strong overnight move don't see danger. They see delay. That's how fresh capital enters late and loud. At the edges, another signal waits. Mining stocks. They were crushed on the drop. They always lag at turning points, but math catches up eventually. If silver holds these levels, miners have to reprice. And when that trade starts, it moves fast. The float is tight. The gamma wall is shaking. And at this point, the market isn't asking where price should go. It's asking how many layers of obligation still sit above it, waiting to be triggered. Zoom out far enough and this stops being about silver entirely. What you're watching is a system confronting a boundary it can't negotiate with. For decades, stability came from flexibility rolling contracts, paper claims, confidence that promises could always be extended. That world only works when supply behaves like an idea. Silver doesn't. It behaves like a limit. Every phase you've seen followed the same path. Control was applied, fear was injected, weak hands were removed, but instead of resetting the system, each move exposed how little slack was left. The float tightened, obligations stacked up, old tools were used and failed, and once scarcity took over, price stopped being a debate and became a consequence. This is the part most people misunderstand. Markets don't warn you loudly when structure changes. They whisper through hesitation, failed sell-offs, and pressure that no longer releases. By the time the signal feels obvious, positioning has already shifted. This isn't about being bullish or bearish. It's about recognizing when a system built on promises runs into something real. When that happens, narratives lose power. Timing loses power. Even belief loses power. What remains is constraint. Silver didn't break the system, it revealed it. And once something real exposes a limit, the system doesn't correct it gently. It adapts around it unevenly, painfully, and without asking who's ready. So now the question isn't where silver goes next. It's where you stand when a system built on paper meets something that can't be printed, delayed, or rolled forward. Every piece of this story connects the tightening float, the failed sell-offs, London flipping from supplier to buyer, the pressure building above 65. None of it is random. It's the same pattern markets follow right before they stop behaving the way people expect. If this really is about constraint, not speculation, then doing nothing is still a position. Waiting is still a bet. Trusting that the old playbook will work one more time is still a choice. And history shows those choices are usually made right before the rules change. So here's what I want to know. Do you think this ends with another controlled pullback like we've seen for years? Or are we finally watching the moment where paper promises collide with physical limits? Drop your take in the comments, not what you hope happens, but what the structure is actually telling you. And if this breakdown made you see the market differently, hit subscribe. Because the next move won't come with a warning, and the people who understand the mechanism always see it first.